Good morning, ladies and gentlemen, and welcome to the SMARTSPACE Software PLC final results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that today's presentation is being recorded. Before we begin, we'd like to submit the following poll. And I'd now like to hand over to Frank Beechner, CEO, and Bruce Morrison, CFO of SMARTSPACE. Good afternoon.
Good afternoon, everybody. I'm Frank Beechner, as Mark introduced us there, and this is
Bruce Morrison.
Great. What we're going to do for the next hour or so is to combine the results presentation with giving you a slightly deeper insight into the business. We had plans early in the year to try and organise a capital markets day where we give a sort of deeper insight to the business. The practicality of doing that actually got raced ahead of us. And we've come up with a model today which involves two short video presentations, one from each of our software businesses, give you a chance to understand those businesses, the technology and the people a little bit better. And we'll drop out to those at two different points in the slide presentation. I suppose the big question in everyone's mind right now is the impact of COVID on our business. Bottom line, really, from our perspective, is that we traded very well through lockdown. We had some challenges in A&K, mainly down to the fact that our customers were closed and we couldn't actually get on site to effect implementations. But even that's unlocked now. Despite that, A&K actually traded really well. It was ahead of the revised budget that we put in place for that business. So we're happy with progress in that business. But the software side of the business, as you'll see in a while, actually worked really well. We did see a slowing in the UK and US markets, but that was that's now seemed to have rebounded. And we were buoyed by the fact that we sell across the globe. Thankfully, everyone got through COVID safely. We had 2 or 3 people with infections early in lockdown. No one was hospitalised. As you'll have read in the press, New Zealand has done particularly well through COVID. And working from home worked well for us as well. We didn't see a drop off in productivity. I mean, we're fortunate to be in an industry, with the exception of A&K, where a developer, in many cases, is even happier sitting at home tapping away as being in the office. So that was good. And of course, we've modified our product range during the process as well. And you'll see in a little while when we go through the technology how we've adapted our tech to suit COVID-related functionality requirements that we've seen come up from customers, and we've embedded those into the product. There's definitely a focus now on getting back into the office. We've seen that down in Australia, New Zealand, and it's already starting here, despite the fact they're talking about all the lockdowns and that, because many companies are using the time to actually get organised so when they go back, and where the issue of in-house contact tracing, screening of visitors, all of that is actually important. So we'll press on to the next slide. I don't want to go well on this too much, but I know that there's some people on this call this morning who may not have heard our story previously. But really what we are as a business, that between 2014 and today, we've transitioned from a 26 company sprawling group covering everything telcos and low margin IT services to being a much more focused SaaS business. And I'll leave you to just this slide in your own time afterwards. But as I say, it's a story of a business that's been in a transition for probably 4 or 5 years, but rapidly accelerating to where we really want to be, which is a large volume SaaS business spread across the globe. The enterprise business we sold on the 13th of August. Bruce will chat through some of the headline points from that.
Yes, the enterprise business was part of our product portfolio prior to August. What we were finding really was the nature of the customer base, with high dependency on a small number of customers, together with, quite often they wanted on-premise deployments, and that led to lumpy revenue, complex installations, and we didn't really have the professional services organisation to support many large clients. What we did was we took a decision to get out of that business and to focus on high growth, small to mid-sized businesses, sort of up to 1,500 employees per location, through our other products, Space Connect and Swiped On. So we sold it to a company called Four Winds Interactive, based in Denver. What we've seen, the impact on the group is to reduce our fixed costs. Our headcount's come down from 124 to 50 since January. We switched from 4 premises in the UK to 1. Now our revenues were reduced, but we've removed the losses, and the propensity for that business to deliver big lumpy items of revenue, but also the potential to cost us lots of money. That's puts less pressure on working capital and has freed up some cash through the disposal to allow us to focus on and accelerate the growth within our mid-market and small businesses. The consideration we received was 5 million, 4.6 million paid on completion, and we get a further 400,000 approximately when the company receives R&D tax credits. We hope will be in November or possibly December, once they file their audited accounts and their tax returns for the financial year to January 2020. We do have an ongoing relationship with Four Winds. They will resell our visitor management software, Swiped On product, rebranded. And we have a sort of a two-way referral process where they will take on any large customers that we identify are not appropriate for our software. And similarly, they will refer smaller clients to us. So that basically sums up where we are now. And I think Frank will go on to talk about where that leaves the group following the disposal.
So we've now got 3 operating businesses in the group. Swiped On, which is visitor management system, based in Tauranga in North Island of New Zealand. It's a business we bought back in 2018. It's got 29 employees. We've got Space Connect, which was based in Australia. Now we don't have any links back there. We don't have any staff or offices there. It's all in the UK. They've got 12 employees. They operate out of the building we're both in here today in Mildenhall in Suffolk. And then we've got Anders & Kern, which is a business that we've had since 2017. Traditionally, it was an AV software distributor business, but we've actually moved it through to becoming more focused on smart workplace technologies. And we've signed a number of contracts, which we talked to you about in a little while, about this business and how it's important to the group. It's got 14 staff. In addition to those staff numbers, then there's four staff, Bruce, myself, and 2 others at the group, plus 2 non-exec directors. So if you think this time last year, the group had about 140 people. We're down now to about, I think it's about 58 or something like that. We don't anticipate it to grow a lot more than this. We see us getting to about 65, 68 people during the course of next year. And that's really where we're looking at scaling, maybe some development resource and maybe some sales support. But we're definitely not talking about big numbers. So moving to really a tight cost model, which is characteristic of a good SaaS business. As I say, we've got 3 offices now, Mildenhall, which is a building owned by us. We do a lot of things out of here. Obviously, ANK is headquartered here, but so is Space Connect. We're in the process of building a combined tech support desk for both Space Connect and Swiped On from here as well, so that we get the economies of scale. The intention is to service customers from East Coast US to the UK to the Middle East from here for both Swiped On and Space Connect. And then we're also running sales of Space Connect and Swiped On from here as well. So it's quite important to us. As I said, the building is owned by ourselves, so we not paying expensive rents, and we don't have expensive service charges. And it's in quite a low-cost part of the country, which is quite important for managing our costs going forward. Swiped On is based in Tauranga. Again, you'll see this. We're going to show a video in a little while. And we've got a small satellite office in Austin. It's with just 2 people there focusing on sales and tech support of the Swiped On product to our US customers. We've got currently at the end, this number is at the end of September. You'll see other numbers quoted in the deck as we move forward. Some of those at that period end, so at the end of July and that. This one is the figure as of the end of September. We've got 4,560 customers spread over 73 countries. Our largest market is the US, and then after that, the UK, Australia, New Zealand, and Canada. nearly all of our marketing dollars go into those into those markets. If we do pick up customers in other markets, we haven't necessarily run AdWords campaigns or anything in there. You'll notice there's a lot of big names on our list, and we have in our pricing model, we have an enterprise pricing plan. That's not to say that you've just got out of enterprise, you're going back into enterprise again. It's actually enterprise in name only. If we sell to, say, someone like DHL, it may be the equivalent of 300 sales of one of our visitor management modules, as against going in, getting involved in a 6 or 12 month sales cycle with lots of demonstrations and lots of complexity. But we're ultimately, the message we want to get across really is to sort of let people know that we don't just focus on SMEs, that there's a demand for our products at the SME price point and at the SME speed of configuration and deployment with big businesses as well, which is going to be a big area of growth for us going forward. What we'll do is just switch across to a slide, a quick video now, and this is the team in New Zealand, just giving you a quick run through the product, our routes to market, and our business model. So we'll hand over to the video now.
Good morning, I'm Hadley Ford, founder of SwipeDon. Thank you for taking the time to be with us. I'm joined by Nicole and Matt, and in the next few minutes, we'll give you an overview of SwipeDon, our product, our customers, routes to market, and our technology. We're based here in Tauranga, in the beautiful Bay of Plenty, North Island of New Zealand. At its core, SwipeDon is a visitor management system used by companies to manage their reception, allowing easy and safe visitor check-in. SwipeDon replaces the traditional visitor book and allows our customers to have a safer, more efficient, and more professional reception environment. Since COVID, there has been a dramatic increase in interest in what we do, but we'll touch on this later as we move through the presentation.
Hi, I'm Nicole and I joined SwipeDon in July as the Head of Global Sales. For the last 5 years, I've been over in London working for Receipt Bank, a global SaaS company running the UK operations. As of today, we have over 4,500 customers, and SwipeDon is used in over 6,300 locations around the globe. This has more than doubled since 2018, when we had 2,100 customers in just under 3,000 locations. These customers are spread across 73 countries. Just last week, we added our first customer in Japan. We focus our marketing activity in 5 main markets. That's the US, Canada, UK, Australia, and New Zealand. In fact, we are now in 48 states of the US, working with some great customers such as Bayer and Krispy Kreme. Our customers range from small single-site operations to Fortune 500 businesses, so there's a good chance you've signed into an office using SwipeDon already. Some of our customers that you may be familiar with in the UK are Skyscanner, Berkeley Homes, and Grant Thornton. Our largest customer in terms of locations is Access Information Systems, from just a single site 2 years ago to over 150 sites today. We're currently working on a number of multi-site deployments, including DHL and other multinationals. And this continues to be a main focus for us to drive further growth.
We're data-driven here at SwipeDon and run the business using a key set of metrics. I'd like to share some of these numbers with you now. Since 2018, we have grown ARR significantly each year. This momentum has continued since the end of the reporting period and even through lockdown. At the half year, in July 2020, ARR was 4.68 million, up 74% year on year. A key part of our strategy is to increase ARPU. In November 2018, just after acquisition, ARPU stood at $57, and it is $87 today, an increase of 53%. We've achieved this by producing an add-ons marketplace, including complementary modules, such as deliveries. Our average cost of acquisition is $1,450, and this returns a lifetime value of $9,025, giving us a healthy CAC to LTV ratio of 6.2. As you can imagine, when COVID hit, we were concerned, but I'm glad to report that the net effect of COVID on our business could be characterised as us having 1 month, April, that showed slower growth than normal. In fact, since May, every month has returned a record performance. The main reason for this is adjusting to a contactless offering and the geographical spread of the business. Since March, we have increased our customer base by 30% in Australasia alone, as other markets were clearly deeper affected by the COVID lockdown.
Our customer acquisition is based around encouraging customers to take a 14-day free trial, which we aim to convert between 20 and 30% into paying customers. In a typical month, we'll add between 120 and 150 new customers. Our inbound leads are all being driven through digital marketing initiatives, mainly organic SEO, paid search, paid social, referral channels, and content strategy. Being a digital product allows us to operate all our lead acquisition in a manner which gives us the freedom and agility to move quickly. Our current sales model is heavily weighted towards inbound sales, but as we grow the team, there is a huge opportunity for us to implement outbound strategies too, enabling us to target certain industries, geographic locations, and size of business. This will see our team become even more focused, targeting the higher converting and the higher value customer segments.
Hello, I'm Matt, CTO at SwipeDon. The SwipeDon stack is battle tested with well over 20 million movements a year. We've been able to handle constant growth and improvements by hiring great developers and building an engineering culture based on teamwork. Our customers benefit from quick response times because we work while they sleep. That's a competitive advantage usually attributed to outsourced teams, but our development teams are just as cost effective and have all the benefits of world-class training and infrastructure, and the IP stays with us. SwipeDon is gaining a great reputation among developers, and Tauranga is now recognised as an emerging tech hub. New Zealand developers deliver great value. They're hard-working, always keen to try new things and share their ideas, and they're well-informed and connected. It also helps that the New Zealand government is a strong supporter of the software industry, and we can take advantage of a 20% R&D rebate through its innovation agency, Callaghan Innovation. All of this helps us move quickly when we need to. When COVID struck, we quickly switched to create a contactless web app, new employee apps for Android and iOS, and key features like visit approvals and alert questions, all designed, built and tested in-house. Now 1/3 of visits are contactless, and we're building out a bunch of new features that are only possible with mobile apps. We've done a lot with our dev team already. We have plans to do plenty more.
Thanks again for taking the time to be with us today. We see significant growth ahead and have 3 key growth strategies to achieve this. Firstly, increase ARPU by upsell, expanding multi-location deals and continuing tiered feature releases. And importantly, cross-sell, adding to our existing add-ons marketplace with complementary technology like desk and meeting room management. Lastly, to accelerate acquisition by expanding into new geographic markets, and we will continue to identify regional opportunities as they arise. We know our market, have proven growth, we're really excited for the future, and we'd love to have you on the journey with us.
Great. So here are some key metrics on the SwipeDon business. I won't, in the next slides coming up, I won't go through these in detail because some of it's already been covered in video and you can refer to it afterwards. First thing I'd like to point out is the view out the window here in Mildenhall is nothing like the view out the window in Tauranga. We don't have the benefit of a 30-kilometre long beach here. We're looking at a car park and grey overcast skies. We've got a great bunch of people down there. We're really fortunate to have them. And, you know, as you see in a little while, we've got big plans for that business in the future. The overall performance speaks for itself. We had a 92.5% increase in ARR between last year and this year. The bit that most people are interested in is how did things behave over lockdown. And if you look on the right-hand side of the presentation here, you can see that between March and August of this year, we actually we increased the number of customers there by 722. We added over 1,100 new locations. We grew our ARR in that period. And as Hadley said, we had one quieter month than normal in April, but then it rebounded really, really quickly. And it started with New Zealand getting back into the office and then carried on when Australia, it started to go back about a month later. So while things were slowing here in the UK and in the US, we were actually starting to motor in New Zealand. And in fact, we grew our customer base and revenues in Australasia by 30% during that lockdown period. So yeah, so they're the headline numbers really. So all of the dials are heading in the right direction. They have been since we bought the business, and each time we introduce a new initiative, it seems to, you know, if it works, we'll do more of it. If not, we actually would we back off, but we don't overcommit to something. Going for that, as I say, that big chance that it might actually come off. We focus on our marketing spend on 5 key markets, basically English-speaking markets. Our largest customers on the video there is Access Information Systems. Only a small percentage of our revenue in Swiped On actually comes from partners, so that's going to be an area for growth for us in the future. It only is less than 1%. We've got about 30 partners in total, mainly recruited through a platform called Partner Stack, which basically allows partners to sign up for with SaaS businesses like ours. It then handles all of the sign-ups, gives them the collateral. It then takes a margin for the service, and then it sends the appropriate amounts back to us and back to the partner. We can see that growing. We just signed one up recently in Singapore, and he's brought us, I think, 8 or 10 customers really, really quickly. The largest partner deal we have done at Swiped On is with a company called Office Max. They're the equivalent of Viking Direct or Staples in New Zealand. They're actually owned by Office Depot in the US. Now they've got over 30,000 small business customers in New Zealand. They were a bit slow, I mean, I suppose by virtue of the size of the organization, but they seem to have got themselves galvanized in the last few weeks, and they're just about to start promoting into their customer base. So it'll be interesting to see how that goes. And ultimately, you know, as you'd expect from us, if that worked well, that we'd be looking to move our way up the food chain there to see if we can get to Office Depot in the US. Big part of what we do is about keeping customers happy. We've got great customer satisfaction rating, constantly above NPS scores of 60, and we get great reviews from third-party reviews as well, and they come directly from customers. In terms of the team, you've seen and heard from some of them there. They really are hardworking and very, very focused. We do plan to grow it down there, but not to the point at which we're going to double or treble the organization. We're talking about taking Swiped On up to about 40 employees over the next 12 months, mainly in development and maybe 1 or 2 extra heads in sales. New Zealand obviously coped with really well with COVID, and we've got a really, really good culture down there. You'll see in a second, we're actually planning to do a lot more development down there, in particular with Space Connect, and we've hired our first 2 Space Connect developers there, and they're now working in the office in New Zealand. Part of that culture, and it's something that, you know, we inherited when we bought the business, is that they were very conscious of putting back into the community in which we operate. We've actually planted 4,800 trees, native species trees, around. Very difficult when you come from Ireland saying the word trees. So it's just as well it wasn't 33 trees. So sorry, that's my bad sense of humor. But we've planted 4,800 trees on the basis that each one represents a new customer that we signed. The sharp-eyed among you would probably thinking, but you only got 4,500 customers, but that allows for churn as well. So we don't cut the tree down. You'll be glad to hear when the customer churns. And we also are very active with not-for-profit. So we give software for free. I mean, such as Leicestershire Search and Rescue, they get a copy of Swiped On for free because they're not-for-profit. So that's very, very, very important to us as we're hiring new people in New Zealand. As Matt alluded to in the video, finding people there is become much, much easier, helped by COVID, of course, because people are traveling less, but our growing reputation as a really good software house and a growing SaaS business. As you know, some very famous SaaS businesses come out of New Zealand, people like PushPay and Xero. So, and we've got a growing reputation. Our ultimate ambition is to centralize software development in the New Zealand office. And even when you compare them to the UK, that developer on the screen there that we're talking about paying, you know, that would be paid $90,000 in New Zealand, would probably get high 50s into low 60s in the UK. And even in the Ukraine, where we've used contractors, they've priced themselves out of the market because they come in at between 50 and 55,000 a year. So we can have a really good base with focused people who work while we're asleep and develop great product, and we can do it all for less than it would cost us setting up a big development operation here. In terms of where we go from here and how we grow this business, there's a number of strands we're going to follow. The first thing we can do is just keep going business as usual. If it keeps on the current trajectory and we keep calibrating our marketing, this business will continue to grow at the current rates. But there's a few things in there that allow us to accelerate that growth. One of the things we did through COVID was introduce a QR-only version of the product. Now, up until then, if you wanted to use Swiped On, by the time you became a customer, you'll have had to make the decision to go and buy an iPad and then go and buy a kiosk to put it in, sit on the desk, and then a brother printer, which is probably an investment of about £1,000. With a QR code version, you can simply print the QR code, stick it on the wall, and when the visitor scans their phone, it opens up a web app on their phone. So to the visitor, it looks like Swiped On's on their phone, but it's actually just a web page that's triggered by the QR code. They fill in their details on their own phone, and then it follows the workflow through Swiped On. So if you might have 6 pre-screening questions like, have you got symptoms? Have you been to a high infection area recently, etc.? And that might dictate whether you're allowed into the business or not. So that's so that sort of business as usual combined with new features like that are actually going to help keep the momentum up. And then of course the opportunity for partner sales. I mean, if we can work our way through to other resellers in the US and places like that, and even back here in Europe, in the Middle East, and the Far East, I think we can do very well. As with any SaaS business, one of the most successful ones just get really good at selling more to existing customers. Now, since we took over the business, we've invested in developing a number of modules. We call them add-ons. There's currently 4 of them. So one of them, for example, you saw on screen there, which was deliveries, will allow you to come up and a courier to scan a parcel on the iPad, reads the address label automatically, and then sends the employee a message, say your parcel's in reception, takes a picture of the parcel being delivered. They give us nice incremental revenue. 40% of our revenue at Swiped On comes from 15% of our customers. So 85% of them are on our 2 lower value plans. One is called Starter and the other one is called Business. Now, what we've been doing with Enterprise, which is our highest price plan, and it's Enterprise and price plan name terms, not Enterprise as in all singing, all dancing, highly configurable worldwide visitor management system. And we've been packing that with more advanced features. So let's say I'm a small business. I might be a consultancy. I've only got 50 people, and I could get by on our $30 a month starter product. But if I want to integrate my system with, say, Office 365 or Active Directory, we don't make that available in the lower end plan. So we're shepherding people towards buying Enterprise, and we've seen an uptick in ARPU as a result of that. As a result of that over the last few months. And we will do more of that over time. So we're basically funding people towards the higher price plan. Obviously, multi-location sales are big for us. Nicole mentioned DHL there. This is actually an extract of their website. Now, there's, I'll apologize for the cliches here. I wrote the bullet points in the next section, and I don't think I could cram more cliches into 2 sentences there between land and expand and bottom up and top down. But basically, DHL is an example of bottom up. So we do the deal with DHL. They mandate that all their depots have got to use Swiped On as their visitor system, but they leave it down to the individual depots to actually place their orders. Now we're currently in Pennsylvania with DHL. I think we're in 6 or 7 depots. The full rollout is 300 depots, and we've actually built a dedicated DHL branded Swiped On page, and it's even got a DHL instruction video on there as well with their internal endorsements, etc. And this will be the visitor system that DHL will tell their US depots to actually buy. So we've good hopes of that. And I'm not sure how long it will take us to get to the 300, but that's the ultimate destination. The other type of sell into multi-location deals then is what we call top-down. That's where we'll go and do one deal centrally with head office. They will place the order for 150 copies, and then they will cascade it down through the organization. But big potential for us to grow in the next year and beyond, just by selling more multi-location deals. That earlier slide that we covered, where we looked at the key metrics through COVID. Up until COVID happened, the average number of locations per customers we were achieving was 1.3. So only a small number of customers were taking 10, 20, 40 locations and above. Through COVID, that ratio increased to 1 to 1.6. So we were selling more multi-location deals through COVID, and that's not including people like DHL, because there's only 6 DHL locations in there as of today. But you could imagine the impact of having 300 locations in there. And the biggest benefit of that type of customer acquisition is that the CAC is actually very low, because the cost of acquiring that first customer, that's not repeated as we work the way through that organization. Another big area of interest for us is to actually take our Space Connect product offering, rebrand it as Swipe Done, and offer it back into a select number of the Swipe Done base. Now, it's only select because we don't believe for a second that everyone in Swipe Done will be a Swipe Done customer will be interested in taking meeting rooms and desks. We have a lot of businesses where they're a single site, where they just need it for reception. But our ideal customer, say for example, might be a business who are spending $80 a month with us at the moment on visitor, with a single visitor reception, but they might have 10 meeting rooms. Now, we build meeting rooms at £15 a month or $30. And then if they wanted desks managed by our technology, we charge that out at £4 per month or $8. If they had 200 desks, so it's 200 times 8, and then you've got 10 times 30 on top of the 80, the scale impact on the average ARPU for us could be significant. Now, we're planning to launch that initiative in the coming months, and that's part of the rationale for having a Space Connect dev team down in New Zealand. This will be one of the first projects that they'll collaborate on. And if it works well, we'll do more of it across the base. And I'll let you do the maths on it, but you can see with the size base that we have, we don't need a big penetration to have a significant difference on the business. Geographical expansion is actually very important to us going forward. We ran a pilot last year. We created a Dutch language version of the product. We didn't go to the expense and the time of localizing the administrator console, which sits at the back end of the platform. So that remained in English. But the front end and the marketing, the website, were all converted into Dutch. We've ended up picking up about 50 customers in Holland. When we went back and researched those, one of the things that became very apparent, and it was interesting coming from probably the most Anglophile country in Europe, was the main reason for not converting from a free trial to a paying customer for those people was the fact that we didn't actually have one, local language support, and secondly, we didn't have an administrator console in local language. So that's very much at our forefront now. And we've got a separate development project that's sort of ongoing, where we're actually creating a localization capability in the entire platform. So a few months from now, we'll be able to, if we go into South Korea, it'll be a fully South Korean branded product, not just the front end that the visitor sees, because that's there today, but actually at the back end as well. One of the interesting things that came out of the Dutch experience was we can, in the UK now and in the US as well, key search terms like visitor management system can actually attract very high Google AdWords at up to £20 a click, which is exorbitantly high. And needless to say, we don't hunt on those. We let our competitors waste their money on that. But when we were in Holland, similar to AdWords in local language were coming in 50 and 70 cents. So I think our marketing spend in some of these new markets will actually would work really well. The effort to us to get into new markets then will be once the product's converted, if we get a Korean language set, we drop it into the product, it compiles instantly, so we're ready to go with product. We create a local language website. The Dutch exercise probably took us about a week and didn't involve, it was literally in hundreds of dollars of effort. And after that, then we'd put a bit of marketing spend and we'd aim to recruit a native speaker to actually do the support. Now, we don't provide telephone support. All of our support is done through intercom, which is in internet chat. So in effect, we could have someone sitting at home in Seoul talking to a Korean customer and answering them in Korean and dealing with their queries without the need to set up an office or anything like that. We've just done that very successfully in Austin. We had a chap there called Drew who joined us about 6 weeks ago. And within a month, he was dealing with customer support, and he had actually put his first deals on the board. Again, we don't have some people may be concerned that now that we've got a bit of money in the bank, we go and squander it all in a huge marketing campaign. Our strategy very much is around stick our toe in the water. If it works well, we'll do more of it. If it doesn't, we withdraw. But at that point, if we spent £100,000 or £150,000, we haven't gone and risked the business on it. But again, new geographic markets are very important to us going forward with the Swipe Down business. A&K is a business based here in Mildenhall. It's been in business for about 25 years. We acquired it in 2017. Traditionally, it sold just purely AV products, going back to the days of overhead projectors and things like that. And of course, they've all commoditized over time. we've used the last 6 months, especially during COVID, to reposition this business. So we focus on smart workplace technologies. If you do have an opportunity, I advise you to go and have a look at the A&K website. You can get the link from the main SMARTSPACE PLC website, and it'll give you a flavour of what we do. We've signed a number of exclusive deals. So XY Sense now, we're the exclusive distributor for their tech across EMEA, and we think that product will go very well. Then there's obviously other dynamics at work within those relationships. We want it as a product for A&K to sell, but on the other hand, then XY Sense is a software partner for us, and they're now taking us into customers back in Australia. And we've got a joint customer with a business called NBN, which I'll tell you a little bit about in a while. There's two other reasons why A&K is important to us. They actually have got an established network of 200 UK resellers. We've got about 10 of those currently signed up to become or to be Space Connect resellers. So they're very important for Space Connect and our channel partner model. And the other thing we're doing here in this building, just upstairs from us in this from this room, is we're creating a centralized support desk, and it'll service not just A&K customers, but Swipe Don and Space Connect customers for this part of our of our time zone. So basically everything from East Coast US across to the Middle East. And again, we get the economies of scale. So rather than having dedicated support desks for one product, we can get the economies. And then we have the same thing with actually sales. So the salespeople for Swipe Don and Space Connect are all based from this building. So again, if you're wondering what a hardware distribution business is doing as part of the group and our aspirations to be SaaS, they're critical to our ability to scale tech support and sales going forward. We're focusing with that shift within A&K, we're focusing their product set now. So a lot of the products that we're selling are HaaS offerings. So not only do you buy the hardware, you typically then subscribe to a SaaS cloud plan as well with it, and A&K gets a percentage of that margin. So we're expecting to grow our annuity revenues in the A&K business, and we work in A&K in reasonable margins. We're looking at around 30% gross margin. So when you think distribution, don't think of the Midwiches and people like that of the world where they're happy with 5% and delighted if they get 10%. And then we also provide value-added services. So if we have this room that we're sitting in now, this is a typical deployment. It's a dedicated Zoom room that we built for ourselves, but we build these for customers all the time. And invariably, when you get into contracts like that, it creates opportunity for desk and meeting room management as well. Now, what we'll do is we're going to switch across to another video. This one is actually on Space Connect, and you'll hear from Matt and the team there about the product, and importantly as well, the relationship with Evoco.
Hi, my name is Matt Pope, and I'm the Managing Director at Space Connect. While Space Connect is an Australian business, we no longer have operations there, and our business now runs out of the UK, but we do continue to service our partners and customers there. I moved to the UK with my family last year, clearly for the weather. Space Connect is a cloud-based integrated workplace management system. There are a number of modules in Space Connect, including desk management, meeting room management, and visitor management. These core modules are delivered to our customers through our web and mobile-based apps, allowing users to easily book meetings and desks. Space Connect is far more configurable than other products, allowing partners or customers to set up rules relating to their estate. As a result, Space Connect can be deployed really quickly. A customer can be up and running on the same day, which is very different to competitive products. Space Connect integrates with Office 365 and G Suite, as well as remote meeting tools including Microsoft Teams and Zoom. We have built our technology to meet the demands of the new normal, blurring the lines between in-house meetings and remote. With the onset of COVID, we have launched a range of COVID-specific functionality. There could be a perception that as businesses reduce their real estate, there will be less need for products like Space Connect. It's the opposite. With fewer desks, businesses need a way of booking desks safely and securely. As you can see here, we have developed specific features to support organisations in getting back to the workplace. Our alert features are simple but powerful, a good way for users to be able to remember little things like continuing to wash their hands on a regular basis. We have also developed a contact tracing report that enables organisations to gain quick access to critical information about an employee and what facilities they used in the event of a tracing requirement. Space Connect integrates with a wide range of hardware sensors and room panels, giving customers the choice to select a solution that suits their budget.
Hi, I'm Matt Mackin and I manage our partners here at Space Connect. I joined the business in June of this year, having previously spent 16 years in property and property technology sales. I'd like to give you an overview of our route to market. We operate a channel-only model for Space Connect, and we sell via a network of partners defined in the following 4 levels. Firstly, strategic partner, where we offer a white label version of our Space Connect software. At this level, we expect our partner to have a significant customer base. We currently have one partner in this category, Evoco, and we will explain this relationship in more detail in a few minutes. Then we have a distributor or major system integrator. These partners will either have a network of resellers and have a large customer base. An example of this type of partner is Softcat, and again, I will go into more detail on this relationship later in this presentation. Next, we have resellers, typically AV integrators, selling solutions such as Crestron directly to their customer bases. Finally, we have referral partners who receive a commission. We typically pay 5% to referral partners, 20% to resellers, and 30% to distributors. Strategic partners will generally be on a revenue share model. Our pricing model is based on a SaaS fee per asset, so per desk or per meeting room per month. Our pricing is generally in the region of £15 per meeting room per month and £4 per desk per month.
Evoco is a Swedish manufacturer of meeting room panels. Their current generation product, the LISO, has been deployed to over 300,000 meeting rooms around the globe. For the past few years, Evoco has been working on the next generation product, NASO. This product was shown in public for the first time at the ISC trade show back in February this year. NASO should have been launched by the summer, but has been delayed due to COVID, but is now scheduled to start shipping this autumn. NASO is a cloud-based solution that gives customers the option of buying our meeting room, desk booking and visitor solutions, which have been rebranded for NASO. Our income from NASO comes in 3 ways. A one-off fee for each panel shipped, which is in excess of €70, €36 per annum in recurring revenue per panel installed, and we also receive 30 to 40% of the net revenue from any customers that take up the SaaS solution. A typical Evoco customer has 14 meeting rooms and 300 employees. We would expect our monthly revenue from a customer of this size to be €550 per month.
Hi, I'm Ricky Williams, and I'm the product owner for Space Connect, and this is NASO. Our development team has written the entire NASO operating system and end-user app, including product licensing, registration, and setup. The priority was to create a solution to allow rapid installation and setup of NASO. In this next segment, I'll show you how fast. This video goes through the setup of an Evoco NASO. First, through registration. Next, setting up your digital representation of your company real estate. And finally, claiming a NASO. Our user adds a license file and registers their organisation in the cloud. Next, he sets up his location in Bristol, connects his rooms, setting facilities and room preferences as he goes. Syncing users is easy. Simply set the pin length, whether pins in RFID or no pins is preferred, and then press sync to link users and send out unique pin codes. Now he's ready to claim. Grabs a setup from the App Store, picks a room, enters the wired or Wi-Fi credentials and hits connect on the NASO. The NASO pairs with the phone via an encrypted Bluetooth connection. It downloads the latest firmware and software and is now claimed to the selected room. As Matt mentioned, all NASO customers will use our software. We have created a white label version of Space Connect, rebranded as NASO. Once NASO has been installed, customers or Evoco partners can very quickly activate desk management, meeting room, and visitor management.
Good morning, everyone. My name is Richard Gluckman, and I'm the CEO of Evoco. I want to take a few minutes to tell you about Evoco and our collaboration with SmartSpace. Evoco was established in 2009 as an extension of SMS Smart Media Solutions, which dates back all the way to the 70s. Our headquarters is in Sweden, but we also have employees in Finland, Germany, France, the US, and the UAE. Our main business is meeting room panels, and we were actually one of the first companies in the world to develop dedicated meeting room panels. Today, we're one of the leading brands globally in this segment, and for both our first and second generation room booking systems, we won multiple awards for their design as well as for their innovation. We sell our products through a global network of over 80 distributors covering even more countries. And our meeting room panels have been installed in thousands of organizations ranging from small businesses with only a handful of meeting rooms to global enterprises with 5,000 meeting rooms spread across the globe. Evoco NASO now is our next generation meeting room panel, and we will release it to the market this autumn. We've been working on the NASO for the past few years with a vision to create a product that not only looks fantastic and is easy to use, but which also allows our customers to access a range of SaaS solutions. For the past 2 years, we've also been working with Ricky and his team that have developed the software for the NASO product. Space Connect has been a great partner where our strengths have complemented each other well. We have really benefited from the Space Connect expertise in software development and experience from offering SaaS solutions to the modern workplace. We've ended up with some amazing results thanks to this. Now we're really excited for the future. Even before its sales start, the NASO has actually won its first award, and we get daily requests about when we can start to ship. We can't wait to kick off sales and make the NASO an even bigger success than its predecessors. Thank you for your time today.
On the 31st of July this year, we announced we had signed an agreement with Softcat to resell Space Connect to their customer base in the UK. Softcat are one of the UK's largest system integrators and have over 15,000 customers. I run the relationship with Softcat and speak with their team daily. I work with the technical specialists in the Softcat collaboration team, and they have a defined strategy to provide solutions to help their customers get back to the office. Since we signed Softcat, we have engaged with 19 Softcat customers. Of these, we have closed 8 deals so far. The average ARR value from a Softcat customer is £8,500.
We're really excited about the future. Space Connect have a great product and strong proposition at the right time. Thank you for your time today.
Okay, so I will. We won't go through the detail of the following slides. A lot of it was delivered in that in that video. Our largest customers of Space Connect right now is a business called NBN. They've got 6,000 desks, 160 meeting rooms across 10 locations when fully deployed. I think we're currently at about 2,500 desks of deployment. It's also strategic because it's our first joint customer with XY Sense, and we think that relationship is actually really going to yield a lot for us going forward. We've got the Evoco piece, which you've heard a lot of there in the video. What I draw your attention to is this panel at the bottom here. Now, as was mentioned by Matt, there's 3 income streams from Evoco. 70 euro per panel, and that's paid when the panel leaves the warehouse at Evoco, not when it's installed or sold by a distributor. Then we get, once the panel's installed, it needs to be linked up to the cloud. Once that happens, we get 36 euros per annum, which you're thinking, you know, as an amount is not a huge amount, but if you think the previous generation's product, the kind of volumes it sold, and we get that for every panel, so a 10-panel business is worth 360 euros to us. But you know, the Evoco's ambition for this is to be selling in tens of thousands of units, not in 5s or 10s. And then we also get a net 30 to 40% of the SaaS revenue if people invoke the 3 modules, which basically Space Connect rebranded as NASO. Now, we know from experience that a typical Evoco customer, whilst they've got some customers with 5,000 meeting rooms, the average is 14 meeting rooms at 300 employees. When you actually work out the net income to us for those customers, it comes in at about 550 euros a month. So that gives us a total sort of contract value from that customer net to us of about 21,000, or it equates to a monthly income of 592 euros per month. Now, I know that the modelling that we've done, we haven't been as ambitious or as aggressive as Evoco have indicated, but even on our numbers, it actually shows that this can be a very lucrative, high margin business. But of course, all the development has gone in up front. We've been working on this now for 2 years, and we only start to see income from it as we move through from when it starts shipping. And as Richard Gluckman indicated there, that's due to be any time now. They've indicated the autumn, whether that means October or November. The year end for them is the end of January. For those of you who followed us, you might have noticed we had a problem back in January of this year when we had a hardware supplier of sensors let us down, and it caused us no end of problems. One of the first calls I made after hearing that was to actually Evoco to double check that they weren't going to have a similar problem. At that stage, he had 3,000 units in stock in Sweden, with another 3,000 on a ship on its way there, and they've since ordered another 3,000. So they've got 9,000 units in stock. So they can ship those tomorrow if they got an order from their distributor. Again, if you go to the Anders & Kern website, you can see that the Evoco NASO is now up there, even though it's got it coming soon. And Evoco wouldn't have allowed us to do that unless they believed that the launch was imminent. Ultimately, this business is all about the scalability of a channel to market, or a route to market through channel. Previously, when we had enterprise, we actually had we were involved in direct sales. And with direct sales, it's not just the fact you have expensive salespeople, it's the people you need around them, from pre-sales techies to the guys writing the contracts or writing the bids, reviewing contracts and that. Here, we can scale our business just working through a small number of partnerships. If you look at the Softcat deal, they've got 15,000 customers, and they've got 700 account managers. Our point of engagement is a new team they've created within Softcat called the Collaboration Team. They were created back in March of this year, and their job is to support their 700 account managers around the country. And they've got a defined business proposition, which is getting back to the office, I think is what the team does, and we're a critical part of that offering. One of the first deals that we've come through, one of the 8 that Matt mentioned in the video there, was a company called City Fibre. Ultimately, they've got 35 locations. We've deployed to the first 5 or 6. That's worth 24,000 ARR to us. And the 2 subsequent phases would add another close on another 70,000 of ARR. So that's much higher than that 8,500 pounds ARR that as the average we've seen so far. A big part for growing this business now is really do everything we can to support Evoco, to make sure NASO gets out there. They will take all the first line support, so we don't have to have a huge support desk supporting them. We don't have to have salespeople on the road. Our job will be to help them to cascade the message down into their base of distributors and resellers. And then obviously, at the moment, we've got about 20 resellers for the products across the globe. We want to expand that. At strategic level, like Evoco, the work that we've done for Evoco allows us to actually create a white label version for other partners. So we could go to a property company and they can have property company branded solution that they can offer back into their base. And we don't have to get involved. They can stand up their own customers, and we can then get access to the billing information and know what to charge them each month. And then obviously, we've just announced recently that we signed a deal with ESCO in Singapore. They've got offices all over the Middle East, from Taiwan down to Indonesia and the Philippines and Vietnam. And we're working on the first joint customer there. So it'll be interesting to see how that goes. If that goes well, I think it all goes well for that relationship. And we have a lot of hope for opening up channels in the Far East. You'll have seen from those maps we showed earlier that we don't have a great presence there in terms of customers.
I'll just take you briefly through the financial highlights. Today we've announced our year-end results for the year to 31st of January. We have got an extension of the stock exchange to delay out the announcement of our results for 2 reasons. Firstly, because we were dealing with the disposal of the enterprise software division, and secondly, the impact of COVID, which seems to have had a quite significant impact on the ability of auditors to deliver and complete their audit work. One of the key things to note is that following as a result of the disposal, we'd actually taken the decision to dispose of the enterprise software business prior to the end of January 2020, our last year end. So as a consequence, the results of the enterprise software division are excluded from the top half of the income statement and are aggregated and treated as one line at the bottom of the income statement, the results from discontinued activities, leaving purely the results from the continuing operations at the top. So we are comparing like with like, because we've gone back and restated both the full year for the year to 31st of January and the half year for the last financial, the first half of the last financial year. What's important to note is total revenues have grown by 72%. And this does include the first full year of Swiped On, and our recurring revenues have grown by 310%, again with the first full year of Swiped On. Previously, we acquired it in the beginning of the last quarter of the last financial year. I guess more importantly, as a guide to how well the software businesses have been doing, is the ARR has doubled since last year. Our gross margin is affected by the fact we do have hardware sales within the figures through Anderson Kern. As the software businesses grow at a faster rate than Anderson Kern, that gross margin will improve, and we've seen that in last year when it improved from 38 to 41%, and actually I think it's grown to 51% in the first half of this year. And as we go forward, we expect an increase in gross margin. Our headcount for last year, the average was 48. It would have been 103 had we included the enterprise software, and that excludes contractors within the enterprise software business, which represented a significant portion of that. On the basis of the numbers, we've delivered an EBITDA loss of 1.67 million, which is marginally less than the same period last year. Our operating loss, as you can see within the discontinued operations, was 8 million, although 2.7 million of that represents actually a provision for impairment, as we took and made an estimate at the year end of what we were going to realise for the net assets of that business. We had gross cash 2.6 million at the end of January 2020. Moving into the half year, that cash figure declined to just under 1.6 million at the end of July, but following the disposal of the enterprise software division, cash balances jumped to 5.9 million and were 5.6 million at the end of September. And with a significantly reduced run rate of overheads within the group, then that leaves us sufficient cash to be able to generate the business and take the business hopefully through to profitability. Looking at the half year, as I say, we've seen a growth of 6.5% year on year. I mean, that has been impacted by COVID, as Frank mentioned earlier, with the impact it's had on Anderson Kern, where we did see a fall off in order intake, sort of March, April, May time, before it began to pick up in June. And whilst we're not yet back to pre-COVID levels, certainly it's looking more healthy than it was during the sort of the most of the first half of the year. Encouragingly, though, probably as shown by the figure below, the recurring revenues are up 39% year on year, and our ARR has seen further growth of 17%. And all of this really is before the launch of Evoco, which is scheduled to take place in the autumn, and any benefit of the Softcat and the other distributor deals that we've announced since or at the end of the first half. So you can see the gross margin up from 51%. We would expect that to improve, as I say, with the increasing growth in SaaS revenue, which will outstrip the growth on the hardware side. Our EBITDA loss, a slight increase on last year at 0.87 million, reflecting the fact that in this year we had the overheads of Space Connect, which we didn't have in the first half of last year. And again, we had some operating loss from discontinued operations of 1.4 million, which represents the enterprise software performance. But we offset that by reversing some of the impairments, so we're showing zero really impact on this year's income statement. And following disposal, one of the things that that we will see is an increased proportion of our development costs are expensed rather than capitalised, which means our cash EBITDA will be much closer to our reported EBITDA in terms of the numbers we report moving forward.
Okay, I didn't want to go into a lot of detail on the market and competitors today. There's nothing major to report. I mean, it is a very active market. I mean, there's, Swiped On, people like Envoy, ProxyClick, a lot of them are very well capitalized and that, but they tend to go after slightly different markets. ProxyClick goes after enterprise visitor management solutions, and their ARPU is running into many hundreds of, or indeed even thousands of dollars. People like Envoy, they tend to focus primarily on the US market. I mean, our differentiators really are speed of deployment, value for money, and excellent customer service. And you see we've got great loyalty between across the base of customers that we have. We don't seem to lose business to anyone in particular, and there's definitely there's not a big gorilla in the market that's dominating, that we're fighting against. And I think the opportunity is there to sort of become a leader in the space. I mean, even Envoy, who's seen as the big one in the market, has only got about 10,000 customers, and we think that a lot of those are freemium customers as well. There's two philosophies with SaaS. You either have a free trial with full functionality, then convert, or you have a freemium version with limited functionality and convert a tiny number. And we're a different church to the Envoy people, but when we talk about 4,500 customers, it's 4,500 paying customers. Like anything, we're open to attack from people, but I think that we've got a strong proposition now. And I think one of the strengths of the business is the geographical spread of what we do. There isn't any competitor like ours where they've got a similar geographic spread. Like ProxyClick are active, obviously, in places like Belgium, Germany, France, a bit here in the UK, and a bit in the US. They're doing nothing of any work down in Australia, New Zealand, and if we can really drive on and get things going in the Far East, I think we'll do well. It's a similar story with Space Connect. I mean, the number one player as seen in the UK is Condeco. There was one of the deals that we mentioned earlier. We won that against Condeco actually just recently. And we won it on the fact that one, our product was far more configurable. Two, we could get the customer up and running in a day. They were talking about a month minimum, but generally it's 3 months. And we offer great value for money, which I know isn't very defensible as a proposition. But in this market where price sensitivity is, it just makes the decision that much easier. The key to it then is to be able to get the volume. I mean, we think that Condeco have got about 1,500 customers. So again, we're not talking here about having to build a business for 100,000 customers to become the leader in the space. The addressable market is just huge. I mean, again, it depends on how you want to value it, but we think it's worth somewhere in the region of 1.5 billion around the globe, and 873,000 customers that would be in our target range in North America, and we've currently got a couple of thousand there. So lots to go for really. And there hasn't been any changes over the last few months. And we know that some of our UK competitors struggled through lockdown because they didn't have a base of business outside of the UK. In terms of current trading, we got 5.6 million in cash. There's actually another £400,000 due from 4 Winds, and that will happen once the R&D tax credit has been paid. That's likely to be in November, maybe December. It's normally paid in 6 to 8 weeks once the claim has got in. Now that the audit's complete, we can submit the claim can be submitted. Continue to win customers, as we've alluded to through this. And then Swiped On has actually been a cash break even. We haven't actually given them any money from the centre since last year, and they've been building cash themselves. Now, one of the benefits of the business that we're in is the fact as well, customers tend to pay annually upfront as well, so that helps the cash break even. It actually went into EBITDA or into profitability as well, because during lockdown we throttled back on some of our marketing. So we know that tomorrow morning, if we have the marketing spend, that business will be instantly profitable. But it's a trade-off then between, do we keep our foot on the gas and keep building the customer base? Because the bigger the customer base, the more we can actually cross-sell. And the ultimate strategy really is to keep on driving that ARPU. My previous role as chairman was over at Dot Digital. I remember when we joined, our ARPU was about £100 a month. When I left, it was £1,400 a month, but our customer base didn't change that much in the meantime. the team at Dot Digital just got really good at coming up with more and more things to sell back into that existing base. So in the case of Swiped On, when we do talk about investing, we're talking about adding a dozen people. So we're not, again, going to plunge it into deep losses for 5 years while we chase the market. Our ambition is to, be profitable, be generating cash, and maintain the growth levels. That way we think it's achievable. Of there's no doubt that things will sort of will level off as we go up, but equally we want to compensate for that with some of the upsell and the cross-sell strategies we talked about earlier. A&K did better than we were expecting through COVID. When lockdown started, we had a bare bones budget that showed that business just barely ticking over. It had some very, very good months through the lockdown period, and that's actually and that's continued now as customers start to open up again. The biggest limitation there is that if the customers here aren't open, then you can't go and implement a meeting room, or you can't insert panels, or even go and sort of do the site visits to get the projects planned and everything. And then Space Connect, there's a metric there that will give you something to go on. Whilst it's loss making right now, simply because it's only got its legacy revenue and a little bit that we've added, but we don't need a lot to suddenly make it cash generative. So for example, once NACO starts shipping 250 panels a month, and if we can consistently close 8 new Space Connect deals every month, that business will break into cash break even. And then we've alluded to a number of times in the presentation, our plan is to consolidate all our software dev into New Zealand. We have 2 options there. We can actually, as you see from the numbers we mentioned, we could probably shave a lump off our dev spend, the money that we're spending outside of New Zealand right now, or we can actually have more people for the same level of dev. Either way, it's a good deal for the business, and we've got a great structure down there, as you've seen from the video, great leadership, and I think we've and some fantastic talent, and I think we'd be remiss of us if we didn't capitalize on it. So basically where we're at now is a highly focused group, real focus on SaaS revenue. Appreciate that the margins in there aren't as high as you'd expect of a pure SaaS business. We achieve gross margins in Space Connect and Swiped On of sort of 85% and above, whereas the overall group gross margin will be distorted by A&K, which obviously operates on typically about a 30% margin, which is actually is higher than you'd expect in a distribution business. Our fixed costs are very tight now. There's four people in group, and we operate from one building and a reduced headcount. We happen to be in a part of the country where sort of hiring isn't at London levels, or even further down south, or even in the Thames corridor. And we want to keep that culture going as we move through, so that we don't get we're not interested in spending money where we don't have to, and getting rid of the fixed costs of different premises makes a big difference as well. We want to enact and the growth plans as we've outlined in the earlier slides there, and we are a beneficiary of COVID, really. I mean, it's sad to say, with such a terrible situation the world finds itself in, but the bottom line is that businesses need tools like ours to get back in the office and to help enforce social distancing, help record people in and out, and help and manage hygiene and enforce policy across the workplace. As you've seen, we've got a great opportunity to expand our base. We could turn off the marketing tap, as I said earlier, at any point, and that business would be instantly profitable. I noticed one of the questions that's popped up on the screen there is, what should ARPU and Swiped On be? I mean, it can be anything we want. I mean, I've got a figure of $200 a month in my mind. I mean, maybe a grandiose ambition, but if I could get 10,000 customers with an ARPU of $200 a month, we've got a $24 million a year business, probably making us $7 or $8 million a year. And coming from a base of over 5,000 with an ARPU that's already growing, with some real opportunities to grow it, you're thinking, actually, you know what, that's feasible and doable. But don't take that as a forecast, please. That's just me speculating on what might be possible. Geographical spread represents huge opportunity. I remember, we've got customers now in places like South Korea. We've got customers in around the Middle East, different parts of Africa. every country is actually capable of being a base for us to go into. And I think we've got a good model now based on the Dutch experience last year to go after that. And it won't cost us huge amounts of money to go in and spec and find out really is there a business there that we can turn into profitability quickly. And that addressable market is huge, you know, and our competition aren't thinking that way. I know that for a fact. I mean, they struggle in terms of non-English variants of it, and they haven't been as ambitious as we have around it. And the bottom line then, which is we've got 2 businesses that are a cash break even and a 3rd business that will follow in the not too distant future. And we've actually got plenty of cash in the bank to actually make sure we can execute on our plans. So that's us for today. Apologies if it's over the hour, but hopefully it'll give you a flavour of the business and where we're at.
That's brilliant. Thank you very much, Frank and Bruce. I am mindful of time. I know that we're an hour and 10 minutes in, but obviously we've got the Q&A that we'd like to perhaps go through. But if I could just encourage investors to continue to submit the questions using the Q&A tab situated on the right-hand corner of the screen. But I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that feedback is important to the company, and immediately after this presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can understand your views and expectations. We would very much encourage you, if you could, to provide your feedback to the company. Frank, obviously you've seen the questions coming in. I mean, there's a few of those, and I'm just mindful of time. But we had a couple of pre-submitted questions, and I know that you've touched probably on most of the topics in these questions. But just for clarity, if there's anything to expand on, the first question we had is: there was mention a few months ago that suppliers were impacting your delivery of services. Has this improved, or are you still facing issues?
Yes, well, I mean, that really impacted primarily on the enterprise software business. It did continue to affect that business into the first quarter of this current financial year. The reality is it's not really relevant to us anymore as we've disposed of the business. So we don't have those dependencies within our group anymore. So,
and it's important to point out with SwipeDone and Space Connect, whilst in the odd occasion we might provide the hardware, the vast majority of customers buy it themselves. Sometimes in the UK, for example, they might end up going to one of A&K's partners, who ultimately would have bought the product from A&K, but the customer deals with that themselves. We're more interested just in the software revenue. In the enterprise business, we tend to do quotes that were all encompassing. It was hardware and software and implementation all bundled into one big price, and that had a big impact on our margin, and then exposed us to supplier risks like we had back in January.
Okay, thank you very much. The final pre-submitted question is: please explain the structure of Space Connect and SwipeDone outside Australia and New Zealand, and which geographical markets are you seeking to address?
We've probably covered it in the deck, but our main focus with SwipeDone in particular is obviously the 5 English-speaking markets currently, and then we don't turn away customers, as you've seen from that map there, if we do get customers from markets. But as we get the multi-language capability ready, we then start to pick off markets, and we've got some in mind. But as you'd imagine, we'd probably be putting a bit of focus into the Far East, where this type of system is generally very well received, and they tend to want systems that allow them to conform to legislation and that. So there, you know, that continues to be our focus. I think we've seen an uptick now in the UK in the last month with both businesses, and you know, we've and the US as well. It seems to be coming back on stream despite everything else that's going on over there. But the people are coming back to the table. Ones that had expressed interest earlier this year, they're now back talking to us again, said the project's been reactivated. But after that, I mean, again, you know, do we stop, you know, in terms of having active bases outside of those 5 markets where we've got dedicated local country versions? Will it stop at 5, 10, 15? I mean, if it works, our view will be let's do more of it. And the key to us really is we don't risk the business in any market we go into.
Organisationally, SwipeDone is headquarters in New Zealand, but it has a couple of staff in the US, I think, as we pointed out earlier, and it will have a couple of support staff in the UK as well. Space Connect is headquartered in the UK now, so we don't have any presence in Australia anymore. And they have an outsourced development team they currently use in the Ukraine, although we'd like to shift that development, and as we've mentioned earlier, plan to shift that down to New Zealand to work alongside the SwipeOn dev team as well. So, but that's where operationally, organisationally, those businesses are based now.
That's brilliant. Thank you very much. I guess if I could just ask you to click on that Q&A tab perhaps just mindful of time, and just to remind all investors that the company will review all questions today if we don't get a chance to go through every single one, because there has been a lot submitted today. We'll publish responses on the Investor Meet Company dashboard, and you will receive an email letting you know when those are ready. But perhaps, Frank, Bruce, I could ask you to start at the top and perhaps pick a selection of those just so we can then perhaps close off and then get investors to give you feedback.
If I could deal with the target gross margin, I mean, we would normally expect within a SaaS business a gross margin of 85% and above. I mean, clearly with the presence of A&K in the group, we won't achieve that margin, but we are looking to improve that every year as the business, as I said earlier, with revenues from the software business growing faster than A&K, and if we can get to a margin of 70% in 2 or 3 years' time, I think that's getting to be a much improved position from where we are.
Could I ask you, sorry, also just to read out the question? I forgot to mention that, just so that investors.
What is your target gross margin? Currently seems quite a bit below the norms.
So the next one here is: do you agree that SaaS businesses should trade on 6 times revenue? Is that what you use when you're acquiring businesses? I suppose the answer to that question depends if we're buying or selling. We think the SwipeOn business is worth way more. It's definitely worth way more than what we paid for. We paid 5 million for that business a few years ago. If you apply something like a Bessemer Ventures valuation on that business, it's significantly more than 5 million now. It all depends really on the nature of the SaaS business. I mean, it's one thing about having pure ARR, but you've got to look at things like churn rates. You've got to look at the people. You've got to look at the tech, the platform, the addressable market. But if you're looking at a forward multiple, I think if we were selling this business, which is something you'd want to hear as shareholders, we would be looking for valuations way beyond the 6 times revenue. If we're buying, we want to get a deal. We turned down a lovely deal recently that had a business $3 million turnover, losing $1.5 million a year, and thought it was worth 30 million. So we declined that. Declined that generous offer and moved on quickly. Just going down through the questions here. What will it take for SwipeOn to be profitable? It's actually profitable now. It's at cash break even now, and it was profitable during lockdown when we just dialed down on the marketing spend. If the revenues keep growing the way they're growing, and subject to how much we choose to reinvest, we can get back into that into profitability very quickly. The bigger the base is, if we ever decide to do that, the bigger the base is at the time, then the more we can actually say, let's not forget about new customer acquisition, let's go back into the base itself. But very quickly is the answer to that question. Next question was, where are your customers hosted? We host in Australia and in the US, and we use a combination of Microsoft Azure and AWS. And the hardware business, the implication of the explanation why you own a hardware business, that it contributes significantly to overheads currently. Would you sell it as the 2 SaaS businesses get scale? I mean, you've seen our track record in terms of buying and selling businesses, and the answer to that question is absolutely. We will look at what are the best options for the business going forward. Utopia for us would be a rapidly accelerating software business, at which point either the hardware business has such little impact on gross margin, it's a thing of nothing to us, or we consciously chose to wind it down or sell it on. As you'd imagine, businesses in that space don't get big multiples. What we have in this business, though, is a great infrastructure. We wouldn't need necessarily all the people that are in this business right now, but we would have, you'd end up with the things like the centralized support and the selling and that kind of thing are invaluable, because they in effect are our de facto channel sales arm of the group right now. So, but yeah, the answer to the question is yes, we would, and we would look to optimize value. Obviously, things like making sure we grow the gross margin and everything. We've answered, there was one there on, do we capitalize dev spend? Bruce has covered that, and that we use capitalize a lot under IFRS with the enterprise business, but in the current business, the most is actually expense. For example, one of the qualifying criteria for Callahan down in New Zealand is you're not allowed to capitalize dev spend. You've got to expense it through the P&L. We talked briefly about competitors. This question is, I believe there are a number of competitors in this field. Is this a serious threat to the business? At the end of the day, there's always competitors. We're not coming into a virgin market. On the other hand, I'm a strong believer that the best form of defense in a market like this is constant innovation. We're doing stuff now that we know our competitors are doing, but I know in 6 months' time they'll copy us, by which time we're on to the next big thing. And we can see that right across the business, from the innovative ways that we chisel out Google AdWords and not go for the expensive terms. What they'll find, they'll watch what we're doing, then they'll copy. And I suppose it brings us back to that point that copying is the best form of flattery, really. The key, though, is we don't rest in our laurels. We've got to be very aggressive and keep innovating. ARPU is per month, presumably, question mark. That's right. It's the average revenue per user per month. Government, have you approached government departments? If so, how's that been received? It depends on the country. We've got quite a few local government departments in the US, interestingly, and in Australia and New Zealand. The UK, we've got some, but then again, there's sometimes you have to sort of sign up to sort of different types of accreditation programs. The chances are with government, we'll end up going in through partners. We won't really have the time to sit there and go through the accreditation process, when in fact a lot of the partners that we sell in through already sell into government departments and already pre-accredited. Next question was, any more acquisitions? Are you now done? We'll never be done on acquisitions, is the honest answer, but equally we have nothing that we need to buy today because of a technical deficiency. We bought Space Connect because we didn't really have this agile, highly configurable interface that we needed both for NASO and for a mid-market solution. So we're not sitting here now saying, oh, we've got to have a bit of tech, and if we don't have it, we can't grow the business. On the other hand, if we can find acquisitions at the right price, and they won't be at the level that example I quoted earlier, and they're accretive, and probably will give us a big base that we can lose the cost by bringing them onto our platform, then yes, we would look at it. I can't imagine those acquisitions will be in markets like the US, though. And the expectation or anticipation of share price in the next 2 to 3 years. I mean, we said it a few years ago that a lot of people in the business here are on option plans where our options came at 92p. We've got to have ambitions that are well in excess of that. And when you start to add up the component parts of what we've got here and the trajectory we're on now, there's no reason why we can't have ambitions for share price the share price is far in excess of where we sit today.
That's perfect. Frank, I think you've addressed most, if not all of the questions. There might be the odd one that we haven't got round to, but as I said, we will review those. If there's a response, we can put that where it's appropriate to do so. Frank, perhaps I could just hand off to you now just to wrap up. I will then direct investors to give feedback. Over to you.
Great. Well, just to say thank you very much for your time today. Apologies to the people who've heard a lot of the story before, but at least you know that all things are well and COVID hasn't devastated our business. And welcome to those of you who are hearing the story for the first time. And hopefully we gave you a good enough insight today to see that we've got something very exciting here. And again, thanks for taking the time, and apologies for going a bit over.
No problem at all. Frank, Bruce, thank you very much for updating investors today. Could I ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, the feedback page will appear. If you accessed it via the link sent to you by email, you'll be asked to log in to then just submit your feedback, but we'd be very grateful if you could provide your feedback to the company. On behalf of the management team at SmartSpace Software PLC, we'd like to thank you for attending today's presentation. That now concludes the session. Good afternoon to you all.
Bye-bye.